Well, welcome into Making Sense. You know, when you were kind of young, just got married, buying a house, had a wife, maybe, you know, some children, you were a little bit concerned about what happens if I were to die. And of course, at that point, you bought an insurance policy, and that was to ensure that your family would be taken care of in the event something happened. Well, now, maybe you're an empty nester. Hopefully you're still married. The kids are off, the house is paid for, and you're wondering, what do I need to do with this policy? Well, I brought in the expert, Brandt McDonald with McDonald, Barranco, Hagen Wealth Management. Glad to have you back, buddy. And today we're going to talk about insurance because, like I say, a lot of our viewers, probably in their late 20s, early 30s, they got into some kind of an insurance product.
Right.
And they may have stayed with it all during this period of time.
Yeah, you know, the insurance industry has changed considerably over the last many decades. We're sort of in a new modern era now, if you will. And one of the things that we try and do at our firm through a comprehensive wealth management program is to really evaluate insurance policies, to look at what our clients have now. Do they still need them? You know, and the thing that's interesting, we find more than not, is that they're probably more overinsured these days than they need to be. It's sort of interesting to me. But you know, insurance is one of those things, Jack, where our philosophy on that is you know, let's just solve for X. It's an algebraic equation at the end of the day.
Absolutely.
I don't want to get too complex, but you do an analysis for the client that says, you know, how much capital would we need to be injected into your estate if something were to happen to you to A, replace lost income, B, pay off debts, or C, pay taxes. And so we do those calculations, and then whatever that formula indicates to us, and then we say, okay, this is a part of your balance sheet that you can't take this type of risk. You need liquidity, so let's go out and buy the liquidity. And then it's a pretty simple exercise, you know, of say the top 20 carriers in the United States, which one has the best rates this week. You know, insurance companies, you never want to be loyal to them. I mean, they change their rates all the time, just like mortgage companies do. You know, they're always sort of looking over their hand, if you will, or their balance sheet, and they're saying, wow, you know, we don't have a whole lot of exposure to people in Alabama who don't smoke, who are between these ages. And so we can be more aggressive on our pricing this week or this month. And so the one thing about insurance, again, is you want to shop and try to find a high quality carrier for the best rate you can possibly get, and then always evaluate that year after year after year, because you'd be shocked at the kind of money you can save. The other thing is knowing how to name your beneficiaries. We find that a lot of times people will either name an estate as their beneficiary, which is a critical mistake. That's because once you do that, you completely invalidate one of the great benefits of insurance, which is that it passes outside of probate.
Right.
And it goes straight to a named beneficiary. So if you have an individual who's named, you don't have to deal with the probate courts. It's simply present the death certificate, and on the money goes.
Here's the check.
That's
Here's
right.
the check.
That's exactly right. So we do a lot of high-end insurance planning at our firm, primarily centered around high net worth clients for the most part. These are sometimes more complex cases, but the reason we do that is because there's another part of this that is becoming more and more prevalent today. Insurance is a tax-deferred instrument, and there are new products that are on the market that are really very helpful in terms of solving long-term care insurance needs or solving tax problems, particularly tax issues, because we see the deficits where they are, we see the debt levels where they are in the country. There's a real concern that tax rates are probably going to go up for higher net worth clients over the next 3, 4, 5 years. So right now is a pretty good time to sort of evaluate that in terms of how could we position non-qualified cash or non-retirement monies into totally liquid insurance contracts that are tax deferred, if you will, just to shelter any interest, dividend, or capital gain type income from taxes. And so there are a whole host of solutions that are available. We find that most insurance agents are pretty good guys and pretty good, gals, if you will, and they're doing a good job. But and so we don't want to knock them at all. But the one thing that I would say is that having sort of an unbiased wealth management team that looks at the entire industry and looks at your whole balance sheet in conjunction with your liquid assets, your closely held business interests, estate planning concerns for your children and grandchildren, all of those things should be considered in totality, and then come up with a solution for the cheapest way possible.
It's almost like when you see people saying go to that independent agent for your auto insurance because he's going to shop, he's not loyal to one company, he's going to find the best bet. The same thing would happen in other insurance also.
That's right, and one of the things I think that we pride ourselves on is that we manage a considerable amount of money. We've been all over the country and met with some of the most shrewd, most professional planning teams around the country, and there are some cutting edge solutions that are available that most people don't know about. And all we're trying to do at the end of the day is to bring the best solutions to the table for our clients in the cheapest possible way. And I think probably the key takeaway in this message is that most people do not review their insurance like they should every year. They don't review their beneficiaries, and they don't take time to analyze how much things have changed in their own life over the last 10 to 20 years, because once you go 20 years down the line, everything has changed. And you've got to revisit that, rethink it, take a look at your current situation, and ask the question, am I overinsured, underinsured? Do I have the best mechanism, if you will, in place to achieve the goals that I'm looking to achieve? So insurance review is one of the main things that we do with our clients, and I would encourage everyone out there, whether it's us or someone else, sit down with a competent professional and really take a look at your situation.
Good. Thank you so much. And just remember this: the times have changed, the policies will change. Get some good advice before you make any decisions. We'll be right back right after this.